Okay, in the last class, we have seen introduction on amalgamation and we saw the differences between amalgamation, absorption, and external reconstruction. Today, I'm back with part two of amalgamation of companies. Learn with me in short videos with detailed conceptual framework. Okay, hello everyone. Today we'll be learning purchase consideration and furthermore concepts. Now we will look into what do you mean by purchase consideration? Purchase consideration is nothing but, as I have told you in the last class, if you want to go buy something in a shop, you need to give money in return. Then only the shopkeeper will be able to provide you the service or provide you with a good. So, something in return. That is the thing. Okay. In amalgamation of companies, how the purchase consideration will be calculated or how it is considered. Let's have the classic example as we had in the last video's explanation. Instagram is taken over by Facebook. So the Facebook is giving, the transferee is giving to the transferor preference shares, equity shares, debentures, or from for in the form of cash or in the form of check. There are different stakeholders in the transferor company, like in the transferee company. So the transferee company has to give shares, I mean, the consideration to the transferor company. So the transferor company will be able to divide it among the stakeholders. The stakeholders will be in equity shares, equity shareholders, preference shareholders, or debenture holders. Okay? Okay. Now, the purchase consideration, like how it will be distributed. The transferee company will not give the purchase consideration for equity shareholders in the form of only equity shares. It can give in the form of preference shares, debentures for equity shareholders, in the form of check for equity shareholders, in the form of cash. Or for preference shareholders, the same goes here as well. In the form of equity shares for preference shareholders, in preference shares, debentures, or through check or through cash. Same holds for debenture holders. Right. Equity shares, preference shares, debentures, bank check, or cash. So now the question is, would all these be considered as purchase consideration or a component? My question is, does the purchase consideration matter to whom it is given or in which form it is given? Please think over it. Okay. The answer would be the purchase consideration is calculated on the basis of to whom it is given. Right? It can be given in equity shares, preference shares, debentures, bank, or through cash to equity shareholders, or vice versa to both preference shareholders and debenture holders. So, this is the case where most of you go wrong, right? This conceptual clarity is very, very important. Okay, there is one point I left to say is there is a note. Whatever you pay to debenture holders, they are not considered as specie because they are not owners of the company. Like, unlike the equity shareholders and preference shareholders have preferential rights in capital repayment and in the payment of dividend, debenture holders are, as we say, they are creditors of the company. it's like settlement of liabilities, not paying consideration to them. So it is not considered as a payment of purchase consideration to the debenture holders. It's just a settling of liabilities to them. All right. Okay. Next concept we have is computation of purchase consideration. So the computation of purchase consideration comes in four different categories. They are lump sum method, net payment method, net asset method, and intrinsic value method. Now we'll go one by one. In lump sum payment method, the amount which the consideration needs to be paid will be already shared by the transferee company to the transferor company. So in examination also, the purchase consideration, the amount, say maybe 20 lakh, 30 lakh, it's just an example, will be shared in the question itself. A lump sum amount, a fixed lump sum amount, not in part payments or not in shares or debentures or preference shares. A lump sum, a so much amount, a handful of amount will be agreed, predetermined by the transferee company to pay to the transferor company for acquiring their business. Here, the transferee company acquires its assets, liabilities, and business. The three components is very important. So, that's bring me to the second method is net payment method. In net payment method, the details of the payment made by the transferee company to the equity shares and preference shareholders of the transferor company is provided. Okay, let me tell in detail, and or let me explain it to you in detail. What this point says is that the transferee company will give equity shares or preference shares to the transferor company in ratios. Say, for example, if three equity shares are held in transferee company, the transferor company will get two shares. It's the ratio 2 is to 3 or 3 is to 1. If one share is held by the transferee company or if one share is held by the transferor company, the shareholders will get two shares in transferee company. As we saw in the basic points, like for determining amalgamation in the nature of merger or purchase, 90% of shareholders of transferor company should become the shareholders of transferee company. Likewise, this applies. It's basically the proportion. That is it. Okay, we'll see the next point, that is net asset method. Let me read the sentence for you. Consideration to be paid by transferee company is arrived based on the value of the assets, liabilities of transferor company taken over by transferee company. Let me explain this to you. When the business assets and liabilities is being taken over by the transferee company, the transferee company makes a list of assets like the furniture is so much, the machinery is so much, the asset is so much. They arrive at the total value of the assets, right? Then they minus it with the liabilities. They deduct it with the liabilities, which gives us the net asset. So that will be the purchase consideration. There will be cases where the transferee company may not take some assets from the transferor company. And also, the cases may be they both need to agree to the value. Say, for example, one machinery is a 10 lakh. The transferor will say the machinery, the value of the machinery is 10 lakh. The transferee says, no, no, I will take it for 7 lakh. So the transferor says, no, 7 lakh is not good. Please do it for 8.5 lakh. 8.5 lakh. The transferee company thinks for a while and okay, says yes. So they mutually agree to take over the assets at mutually agreed price. So this is the crux in the net asset method, where the total assets is calculated and deducted by total liabilities available, right? So this is the net asset method. Okay, now let us see the intrinsic value method. The last method is, let me just read through it. Consideration is calculated at intrinsic value of shares of ROR and RE, transferor and transferee company. It's just the balance sheet method, or the assets and liabilities will be valued at its fair market value. It's just simple. Okay, we finished this. Now let's move on to this part. That is, what is this? PC is greater than net assets. When purchase consideration is greater than net assets, the net assets, when purchase consideration, when the transferee company pays more than the net assets of the transferor company, it will be a goodwill, right? Goodwill or a capital loss. When the purchase consideration paid by the transferee company is lesser than the net assets worth, then it goes to capital reserve account. So this is simple explanation. Just make a note of it. Purchase consideration which is greater than the net asset will be equal to goodwill or capital loss, or when purchase consideration is lesser than the net assets, it's equal to capital reserve.